Hey, what's going on, guys? Jeff Coga here, and welcome to the YouTube channel. Yes, so as what I want to talk about today, I've been up fairly early today. I've been watching the actual stock market with some couple trades that I want to do, and I want to talk about a concept called institutional investors versus mom and pop investors. All right, and I'm going to give you two examples of this, because if you did organically search this on YouTube, you're probably interested in on what type of investing. And when you invest, there's always two types: institutional investors and mom and pop investors. All right, so regardless if it's the equities market, right, which is the stock market, and or even real estate. All right, now what is an institutional investor? Okay, institutional investors are like hedge funds. All right, the ginormous people who have deep pockets when they invest. I'm talking about they're definitely in the 2 comma club, okay? And then as well as they have millions and millions of dollars, and they typically, the investors that invest in their funds are pensions, credit investors, and other type of people that have tons and tons of money, okay? Versus which majority of the individuals are, okay? We are considered mom and pop investors. Like, I'm considered a mom and pop investor, even though I have flipped tons and tons of houses and I have money in the stock market, right? Why? Is because it's not like we have tens and hundreds of millions of dollars in there that we're actively trading every single day and or own you know, thousands and thousands of units, okay? So why is it important to understand this, okay? Is that the strategy for a institutional investor and a mom and pop investor is going to be slightly different, in my opinion. All right, and the reason being is this, and I'll tell you kind of a quick story if you have some time and you want to listen to this. Okay, so I'll tell you a story about how we found our first institutional investor in the real estate game. Couple years ago. I think this was 2011, okay? And this was a hedge fund, and this particular hedge fund had Wall Street money, and they came into Los Angeles, and they were introduced to us by another gentleman that we knew very well, that we've done and made tons of money with, and their name was kind of funky, okay? It wasn't your typical mom and pop investor name, right? Like, mom and pop investors always have like their name, and or like we buy houses fast or something like funky like that. It was more of like letters, and then it said like LLC, right? Letters and LLC. And then when we looked at the corporate docs, it showed that they're a Delaware incorporated in Delaware, and that's how you can kind of tell, because most institutional investors are incorporated in the state of Delaware. Now, if you're wondering why Delaware, is because Delaware has the longest history of financial court cases, okay? Like, for example, that's the reason why like banks and stuff like that, they're all incorporated in Delaware, as well as like, you know, even Donald Trump and did I lose connection? It says very bad connection. Still going? I think it's still going. Yeah, so yeah, like Donald Trump, other nonprofits, right? Like the big institution with people with like tons of money, they always incorporate in Delaware. Okay, now California, I'm in California, and California is called a brick and mortar state. Okay, meaning that to do business in California, you have to register your entity in the state of California with the Secretary of State, right? So it's not like, you know, sometimes people when they invest, they'll be like, I'll get a Nevada corporation and or Wyoming corporation, and people won't know who I am because of anonymity purposes. I want those entities, and I want to go ahead and invest, you know, create those entities, and then I want to invest in California. Well, California is a brick and mortar, because so you still have to register it here. Okay, so anyone that does business here, you can actually see by going to the Secretary of State with California, and then look at something called the SIA, or Statement of Information document, and you can see where it was originally created, right? So This particular company was created in Delaware, and they started buying houses. Okay, now what we do as a strategy is something called wholesaling in real estate, right? So in the people who are, you know, if you're watching this and you have some experience in stock market, it's literally like trading options, okay, in the stock market, where you have a particular strike price that you're going to you have it under contract for, and then you find a buyer that's willing to pay more for it, right? And that difference is your spread, essentially, in the stock market, right? So we do that in the real estate game, where we'll go ahead and put a contract to offer to purchase an asset like real estate at a certain price, like let's just say $100,000. You're not going to find a $100,000 house in Southern California, but let's just say 100,000. And then if this someone else wants to buy for 120, that $20,000 literally becomes our fee or assignment or assignment fee or whatever, right? By reassigning the contract. So we were doing tons of these stuff, and this particular hedge fund started to buy stuff, and we would look at the resale value, right? Like our price, their price, and then the resale price, right? And that difference right here is their profit. So we would look at it, and then we would be like, oh my gosh, like why are they buying it, right? Like they literally have less than 10% on some of these stuff, okay? And then as we did more and more deals, and then we started following and getting to know kind of the middle person who introduced us to this particular institutional investor, we come to find out that they're really looking to get an 8% pre-tax dollar return, right? Because if you annualize that, meaning like let's just say you get 8% in 6 months or whatever, and if you annualize that, so it's 8 times 2, that becomes 16%, right? So for them as an institutional investor, that was still good. So they went 8%, and then they also even went to 6%, ladies and gentlemen, okay? 6%. All right. Now, why did they do that? Is because, again, if you annualize 6%, you're at a 12%, and then you're doing better than most mutual funds and stuff like that at that time. And the fund itself had different types of profit channel, like a management fee and acquisition fee, right? Of once they acquired, they made a fee. So if the creators of that fund was making money on each acquisition, right? So that's why they were trying to do volume and buy a bunch of properties and to flip it and flip it and flip it, right? So long story short, I think we ended up that one particular year, I want to say we did at least like 20 or 30 to them, right? 20 or 30, and then our other friend did probably another 20 or 30, and then we know someone else that did another like 20 or 30. So they literally bought almost close to like 200, 300 homes. Okay, now I can't say that a mom and pop, you know, I know some of my friends, mom and pop investors, you know, do 300, 400, but keep in mind, like when we looked at the asset of what that entity owned, right, at one time, they owned literally over like $30 million in real estate at that time. That was a lot, right? $30 million of real estate, right? So that fund had like $30 million at least minimum of cash floating around, right? Into doing that. And the point of the matter is they would outbid mom and pop investors. They would outbid them. They simply would, right? And a lot of the mom and pop investors just couldn't buy properties at that time. And then fast forward time, after we made tons and tons of money, right? They sold, and that entity finally, I think it was a 5-year or whatever, and they shut down that entity after 5 years, I think. I haven't checked recently, but the point of it is that institutional investors have tons and tons of money that they're moving around. So us as mom and pop investors, we have to come up with different strategies to make income and to make money as an investor, right? So our strategy of doing option, that was a capital growth strategy, right? It wasn't really a cash flow strategy, okay, when we're talking about real estate, because we didn't hold on to it. Now, looking back now, I wish we held on to those properties and just tenant them out, because we would have been in so much better place. Now, the only issue at that time is the limitation of capital that we had, because I didn't go out and raise tons and tons of money from it, right? So as a stock market, it's the exact same thing, right? Is that you have to figure out a strategy, both on like the stock market and the real estate, of first identifying what your end goal is. Is it cash flow or is it capital growth, right? And depending on if it's a capital growth strategy, right, the way that you execute and make money, your strategy to make money is going to be different than someone who is a cash flow investor, okay? Like cash flow for stocks is like high dividend paying stocks and then you literally don't sell them, right? You buy them and then you hold on to them, right? If anything, you buy more of it as the actual stock dips. You buy more of it. Why? Because you want dollar cost average it out, as they like to call it, to drop your cost of the shares down throughout buying it more and get more freaking what? The dividends, right? It's cash flow, right? So, and then typically they will go ahead and reinvest it, right? Like if you buy it in an index or something like that, right? So it's a strategy. So for me, like in the stock market, when it crashed back in 2008, I started in real estate and it crashed. And then when I started trading leveraged ETFs. Okay, that was kind of my cup of tea, leveraged ETFs, and I focused in the financial sector and the commodities market, right? That was kind of my thing that I did. So as I'm looking at now, like yesterday, I was looking at some trades and stuff like that. I'm going back to what I know. Right, like I looked at some other stuff, right, like growth stocks, some other industry like biotech and things like that, but I really didn't, it didn't feel good because I don't know enough in there, right, and I don't have physical experience doing those trades, right, as a capital growth versus a cash flow. So for right now, I'm trading majority from my retirement account. That's what I'm trading from, right? And so I'm in capital growth mode right now. So I'm debating if I should short the whole market or not, right? That's where I'm currently at. And you know, I'm leaning towards actually going all in and shorting the market because we are at a like almost a 9-year bull run that we're on, right? Like 8 months, right? The most longest one before that was, I think, after the 70s was like 12.9 or almost 13 years, right? So yeah, so even if it's 9 years, I've still got like what, 3 years, you know, 3 years. So if I short the market, I can hold on to these leveraged ETFs, right? That gives me 3-to-1 on my money, and I just keep on buying it and dollar cost it out, right? It's a retirement account. I can't touch it until I'm 59 and a half anyway. So I'm just like, if I do that, I can literally like 30x my money. Right, and that's what I'm thinking about right now, as I'm doing this, right, is to finding these underpriced opportunities and going in there. So another one in the equities market I'm currently looking at right now is natural gas, right? I'm looking at the natural gas sector because I think that's underpriced, and I did a lot of research on it for like the last month or so, and I started actively trading in October of this year. So far, I'll be honest with you, right, actively trading, I'm literally like at a break even. Like I haven't, after fees are taken out, right, when you trade, right, and then these trading fees can eat up into your profits, right? I'm literally like break even. I haven't made any money on it, right? But I am in good position on some of the ones. Some of the other ones I'm kind of like very like, why the heck did I get into this position, right? And it's a kind of really speculative too, that I got into it, which is the dumbest thing to do as an investor. So again, it's just like the video I did previously about marriage with money, right? It's really holding on to me because I'm finally, you know, getting back into it, and I'm kind of like, you know, so again, be aware of that, right? That difference between institutional investors and mom and pop investors, and on top of that, understand the difference between capital growth strategy and cash flow growth strategy, because based on that, your strategy on how you make that money is going to be dramatically different, right? And then understand, is it a tax deferred, tax free account, right, like a retirement account you're trading under, and or is it just like cash, right? Because if it's just straight cash, then every single time you sell and stuff like that, right, you have tax consequences, versus if you're in a tax deferred account, typically the only fee that you have is your fee for commissions you're paying for trading, right? So those eat up into your profits, so you have to be really aware of that. So I want to make this quick video to let you know that those things do exist, and if you are searching the internet for that, be aware of that, be cognizant about that. And one final value I want to give is, if you're watching this and you magically got to this video and trying to find out how to invest in this unique market that we're currently in, is to read history, ladies and gentlemen. Understand history. Understand history. Okay, understand history. History never repeats itself, but it rhymes. All right, that's what I got. This is Jeff Coga. Love y'all. I got to get in the office and get to work. So take care. Bye-bye.